you're with us here on Business Today, and it is our special segment Ask Udayan this Wednesday, the show where we answer all your stock-specific questions and queries. Our global business editor, Udayan Mukherjee, will be taking some specific queries on this segment where we decide what some of the best strategies are at a time like this when markets are trading at those record highs. Do keep sending in your questions to the number on your screen and we'll answer some every week as promised. Let's begin and take some of our viewer queries now. Our first question today is from Ryan Yusuf. He's from Bengaluru. Listen in.
Hi Udayan, my name is Mohammad Yusuf. I'm from Bangalore. What is your view on Coal India at this market level? It went up to 200 rupees, now trading at 176. Is it a good buy? Thank you.
Hi Yusuf. Yeah, it was a very quick rally and an unexpected one at that. Coal India moved up very quickly and quite uncharacteristically from 150 to 200 in just a matter of a few days. And therefore there has been a pullback. I think the pullback has partly been because investors have realized that the government has told Coal India that it cannot do e-auctions of coal right now, and it has to divert most of the coal it produces to the power sector. It cannot sell to the non-power sector, and particularly through e-auctions. Now, investors always realize that e-auctions is the more profitable and higher margin sales for Coal India, and because of the diversion away from the auctions, Coal India's profits might take a little bit of hit in the near term. But I think this is a temporary issue because come winter, by December at the latest, I think Coal India will get back to selling coal through e-auctions once again. So this setback per se has probably been the trigger for profit taking after such a sharp run up from 150 to 200. Coal India, from a valuation point of view, looks quite attractive. I mean, there is no denying that. I mean, it's a 40% ROE company trading at a 6 PE multiple, and it has a 10% plus dividend yield, I mean, which is among the highest that you see in Indian stocks. So if you look at it from that point of view, and the fact that Coal India can grow its profits by about 25% over the next couple of years quite effortlessly, it looks like a compelling buy. And I think if you're a tactical investor, which means that you're looking at it only for say 4 to 8 quarters, you could probably stay invested in Coal India at these kind of price levels, because it is possible that because the market's focus is now shifted to the cheaper stocks, that Coal India will give you a run up maybe even to 250 kind of levels. But if you're a real long-term investor and you're looking for longer-term wealth creation, I would suggest that this is not the sector to be in, because the coal and coal-powered power companies like NTPC, these are yesterday's stories. The world is moving on to renewable energy, and sooner or later they will replace both generators of coal and coal-powered companies, energy companies. So I think tactically at best you could look at Coal India, but from a long-term perspective, I think the fact that it's so damaging to the environment puts it in a negative investment list.
Okay, well then our next query is from Ashwin Kumar, who is from Mumbai, and he has a question on IRCTC, which is interesting given the kind of action we've seen on that stock. If we take a look post-listing, of course, but also just in the last week.
Is it a good time to buy IRCTC stocks?
It's impossible to time this one because the movements, as Abha just mentioned, have been so fast that I think it has taken the breath away, knocked the breath away from investors. Because I think part of the problem is that IRCTC had an absolutely vertical rally in the month of October. I mean, in the start of October, it was around 4,000, and suddenly in a matter of 15-20 days, it went up to 6,000. I mean, that's a 50% rally in less than 3 weeks. And thereafter, there has been a major fall. From 6,000 back down to 4,000 levels. So in a matter of 4 weeks, a stock has gone up from 4 to 6,000 and 6,000 back to 4,000. I think there was a lot of speculative activity in IRCTC, and which is unwinding right now. I don't know what was the trigger that pricked the bubble. Maybe it was some kind of rumor in the market that IRCTC will be merged with RailTel, and which is something which investors are very cautious about. Maybe that is the one which led to the unwinding of all the speculation on IRCTC. And it had become too expensive. I mean, a stock like IRCTC trading at nearly 90 PE multiple, I don't think it was sustainable. Even now, after the correction at 4,000, the stock is trading at about 70 kind of PE multiple, which is very lofty. So I think the stock may need to cool off a little bit more. But the story is good. I mean, it's in internet ticketing, which is growing. The catering business is growing. We discussed this stock a few weeks back, and even their bottled water business is quite strong. So once you get the stock back to where it was, say, in the early September levels, which is 32, 3300, I think even from a valuation point of view, it can be justified. And at those kind of levels, if you're a long-term investor, you could consider looking at the stock. It's not a recommendation to buy the stock, but simply to point out that let this volatility subside, let the stock find its own level and settle down a little bit, and then you could do the valuation math once again and consider it.
Nitin Mittal also sharing his query from Lucknow. He's a long-term equity investor, and with markets at all-time highs, he's got some queries with regards to some of his investments.
Hi Udayan, I am a long-term equity investor. Since markets are at all-time high, should I stay invested in blue chip companies or book partial profits? Thank you.
It's the most difficult question to answer, sir, now, because, if you had asked me this question even 3 months ago, I may have been tempted to say that you could probably book partial profits and you would have missed out and not been very happy about it. This is a market which has surprised everybody with its absolutely continuous strength on the way up without even pausing for a meaningful correction. So my guess would be only that it's getting closer to a correction. Heaven knows when it will happen and whether it is just round the corner, or it can rally on through Diwali and maybe keep doomsayers and correction callers at bay. So it's impossible to time. But if you are, as you said, you're a long-term investor in blue chip companies, I don't think you need to panic, because even if there is a correction and you can take that correction in your stride, maybe eventually, maybe 3 months out, 6 months out, your portfolio value will be higher, even taking a correction or the current levels into mind. Sometimes in a strong market like we are now, it pays to sleep through corrections, because eventually end up holding and making more money. But if you are the sort of investor who would panic because markets correct, then I think it may be equally wise to take some profits, as you mentioned, maybe take out 15-20% of your portfolio and keep that powder dry in the event of a correction. But you must realize that you cannot time this correctly, and the moment you take profits and you keep that cash, it is possible that for a while your portfolio will underperform compared to being fully invested in the market. So I would say the time is such now, maybe it is prudent to take a little bit of profit, but do not get out of the market completely. I think that would be a mistake.
Wise advice. All right, we've got time for one more question. Monica Chadda, who's from New Delhi, listen in.
Hi Udayan, could you please share your views on Polycab India for the time horizon of 2 to 3 years?
That's a good time horizon. 3 years is a good time horizon. And I mentioned this because Polycab is an interesting company. It's trying to make a transition. Traditionally, it's as you know, I'm sure, that it's a cables and wires manufacturer. That can be seen. While Polycab is a dominant player in that business, it is seen by many as a slightly stodgy kind of business, a business to business kind of a company which sells wires and cables, and you have its peers like KEI and Finolex in the market to choose from as well. The interesting bit is that Polycab is using the cash which is thrown up from the wires and cables business to move slowly to what they call the FMEG segment, which is the fast moving electronic goods, the things that we use at home, consumer electronics. Now, the fun part is that the valuations which are accorded to a wires and cables business are obviously much lower than the valuations which are accorded to a consumer electronics business. So Polycab is trying to basically straddle the spectrum between a Finolex KEI on one side and maybe a Havells or a Crompton Consumer, those kind of companies on the other side, the valuations of which are quite disparate. One's low, one's high. Now, admittedly, that the FMEG business is quite new, and therefore it's only 10% of the overall revenue mix of the company right now. But over the next 3-4 years, if Polycab can make a successful transition and this consumer business becomes, say, 20% of its overall revenues, that has implications for its overall margins, and it has implications for the valuations the stock might command. Some part of the re-rating has happened already. But I think this company, if corrections like you had the stock at 2600 just a while back, it fell to 2200. That may have been an opportunity. So if you see a correction and the stock gives you entry points closer to that 2000 level, I think for the time horizon that you mentioned, it might be an interesting one to look at.